Hi folks, welcome to the Financial Argument. After about a year-long break, I'm back here with you once again. Many of you who have patiently awaited my videos deserve a sincere apology, and I'd like to start by extending my heartfelt regrets. To be honest, I believe that I had completed my mission over the years through the videos I've uploaded. Regardless of view counts, I've been dedicated to delivering the stages of the dark plan, unfolding right before our eyes to you in a quality manner, without hesitation. Consequently, as you've watched each of the things I've discussed come to pass, I know you haven't been surprised, and I understand that you've been prepared. Knowing that there are thousands of individuals who are aware of what's happening across various issues and have awakened from their slumber gives me hope for the future. However, I've noticed that the plan being executed against our civilization, and those who remain completely unaware, has intentionally accelerated in recent months. The fact that these individuals who've been put to sleep are completely clueless seems to have emboldened this ruthless acceleration. And of course, I couldn't remain silent any longer. Powered by your support, I consider it my duty to reach more people and provide them with the necessary warnings. Finally, I will be here with more videos from now on. In order to upload more frequent and faster content, there may be some differences from the familiar style of the Financial Argument. I believe you will adapt to these changes over time. However, regardless of the presentation style, rest assured about the accuracy and quality of the information being delivered. There is a lot that needs to be discussed and analyzed, and it's not feasible to delve into each one individually. Nevertheless, I will attempt to touch on all of them as opportunities arise. So, if you are ready, let's get started. If you've watched my previous videos, you've seen that my predictions regarding China have come true. Chinese companies are indeed in a very tough situation. However, many experts are either mistaken or deliberately misinterpreting the situation. They are not aware of the effects that struggling companies in China will have, and it goes beyond a mere domino effect. This economic turmoil is not solely related to China. Everything happening in China is directly linked to the United States. Furthermore, as I mentioned before, the United States has been chosen as the epicenter of a planned economic collapse, designed by someone and implemented in various fields. Our citizens will be the ones most affected by this economic collapse. In this context, let's clarify some things by looking at the US dollar and the Chinese yuan graph. When we look at the graph, we see that the Chinese yuan is trying to go up, meaning it is losing value against the US dollar, but the Chinese government is currently preventing this with intervention policies. This essentially means that Chinese companies, due to their difficult situations or pessimism about the future, are demanding excessive US dollars. This, in turn, causes the value of the Chinese yuan to decrease. The Chinese government is seemingly intervening in the market by introducing various assets to prevent the depreciation of the yuan. However, the currency manipulation intervention carried out by the Chinese government today is entirely part of the master plan. It's a long and quite detailed plan, but I'll try to explain it briefly for you. The effectiveness of this plan was successfully tested in 2015 when the Chinese government received instructions. When you look at the graph, you can see that in 2015, the Chinese government deliberately applied pressure to the exchange rate for a long time, and at the end of the day, they suddenly stopped the pressure by implementing the next phase of the ordered plan, and the exchange rate suddenly started to rise. It would be a big mistake to think that a government like China, in terms of decision-making, implementation, market dominance, and power over its economy, suddenly could not find or lost this power. As I mentioned, this was a situation that was planned from the beginning. Thus, especially developing countries received a serious message with this exchange rate operation to their economies. As the markets of these countries started to enter a chaotic process, the planners who were confident that the message had been received decided to have China adopt expansionary economic policies and ended this exchange rate operation. Essentially, When an operation is carried out against the currency of any country, whether it results in depreciation or appreciation, what should be focused on more is that it is a show of power. Especially since the planners have an asset such as unlimited money printing, it is very easy for them to give the messages they want to the countries they want, or to design their economy in line with their wishes. At this point, your nationality or the name of the paper money in your pocket is irrelevant. Don't expect them to care about millions of people who may fall into financial difficulties or companies that are not their own, because they simply don't care. Let's analyze another economic data point that has been recently shared. When we look at the chart, we can see that the IFO German Business Climate Index has declined much more sharply than expected, reaching levels comparable to the 2008 financial crisis and the 2020 crisis. So, what does this data tell us about Germany? And let's delve into it a bit. Another related data point we should examine is the German Producer Price Index, which has shown a decrease according to the latest data. This means that even though production is happening, sales are not. When we look at the PMI data, the situation becomes even clearer. While there have been occasional decreases in the Producer Price Index, such a contraction had not been seen in the service sector. Even in one of the largest economies like Germany, we are witnessing a contraction in the service sector. We are seeing the same grim picture in the Eurozone, and it's evident that the situation in Germany has spilled over to Europe, clearly indicating a contraction. This contraction, which began on one side of the world, is of course affecting the United States as well. We are not immune to it. When we look at the situation in the United States, it is observed that the manufacturing sector is experiencing a deeper contraction, and although there hasn't been a contraction in the service sector, expansion has slowed down. However, as I mentioned earlier, this negative trend that started in the rest of the world is also reaching the United States. Considering that the summer season has ended and tourism activities are starting to decline, there will be a significant drop in service sector activities. To put it more simply, the world is heading towards a massive contraction not only in manufacturing, but also in the service sector. There are many indicators where we can see these negative signals, and here's another one. There has been a 5.2% decrease in durable goods orders in the United States. This is a significant decline, and I would like to emphasize that even during the 2020 crisis, we did not see such a large decrease. Looking at the market yield on U.S. Treasury securities at 10-year constant maturity chart, we can see that it has climbed to levels seen during the 2008 financial crisis. This is a highly dangerous situation for the markets. This week, there has been a significant decrease in deposits at American banks. When we look at the chart, we see that nearly $50 billion has been withdrawn from American banks. This is a critical amount for banks. When we examine the loans, the downturn continues, and there is no sign of improvement. This poses a danger to the banking sector, and it's sounding red alarms for the banking industry. This indicator is used to show how much credit commercial banks provide to the economy and its impact on economic growth. An increasing bank credit level indicates economic growth and activity, while a decreasing bank credit level points to economic contraction or stagnation. In addition to all this, when we look at the chart for the emergency funds borrowed by banks from the Fed, we can see that there has been no improvement. It has reached record levels, and what's worse is that banks will have to start repaying these emergency loans to the Fed soon. Despite many indicators pointing to gathering storm clouds in the banking sector, I'd like to share another significant piece of news that the market seems to be overlooking. Charles Schwab is a highly important bank, both in the United States and globally. According to the latest data from February, they manage approximately $7.4 trillion in assets. Another crucial aspect is that, alongside their banking operations, Charles Schwab acts as a broker in the stock market for other major banks and financial institutions. This involves activities such as the custody and management of their funds and stocks. Given its size, it's not hard to imagine how even the slightest problem at Charles Schwab could lead to chaos in the markets. Last week, Charles Schwab announced a plan that includes laying off employees and closing some offices. In fact, rumors had circulated in the markets during the banking crisis that emerged in March, suggesting that Charles Schwab was also in a precarious position and under threat. Many experts believe that the regulations put in place after the 2008 banking crisis would prevent this fire from spreading to Charles Schwab. However, as you can see, the situation is far from that. While Charles Schwab hasn't provided a specific number for how many employees they will be laying off, they are talking about a layoff plan that will reduce costs by approximately $500 million. So, if everything is fine with Charles Schwab, and there's no problem, why do they need such a massive cost-cutting and savings plan? It points to a significant problem beyond a simple cost-cutting and saving plan. Furthermore, laying off employees implies severance costs, and canceling the lease contracts of the offices to be closed also means expenses. These are expected to amount to approximately $500 million. When entering a period of significant economic difficulties, the company will have spent its potential profits on these expenses. Clearly, the company is in such a difficult period that it will experience a significant decline in potential earnings while having to cover severance costs. The plan seems to be more than just the company trying to save costs. It appears as if the company is intentionally putting itself in a difficult situation. Considering the relationships between many major banks and large brokerage firms like Charles Schwab, a potential bankruptcy could have even more deadly economic consequences than the collapse of Credit Suisse or even Deutsche Bank. Last week, during the Jackson Hole meetings, Jerome Powell spoke and, in my opinion, made a significant admission about the markets, stating that the battle against inflation is not over and that more interest rate hikes could be considered to combat inflation. This essentially means a continuation of contractionary policies. In normal economies, such admissions should be negatively priced in by the markets. However, the stock market continues to do everything it can to close the week in the green in pursuit of the planned illusion. And all this theater is happening right before your eyes, not in secret. The market wants nothing more than to rise, completely disregarding everything else. And in fact, it's ignoring critical news. For example, what helped the stock market close in the green last week was the announcement of quarterly results by the major chip manufacturer NVIDIA. With developments in the field of artificial intelligence, this sector requires more significant chip power. More data centers are being set up for applications to collect, process, and store data, directly increasing NVIDIA's production. So the reported results were quite good, as expected. NVIDIA also predicts that sales will increase in the next quarter. So far, everything seems normal. Of course, NVIDIA will increase its production and sales in response to increased demand. However, what's being overlooked is that the next quarter, i.e., the third quarter of 2023, will be compared to the third quarter of 2022. This means that the growth in earnings will be compared to a negative period. Since 2022 had a poor figure like -16.5%, this situation essentially represents only a baseline increase, not massive growth. Of course, the markets will probably continue to overlook this detail. You can be sure of that. We are truly entering a dark and chaotic period. We are in a moment where large companies are laying off thousands of Americans in bulk, and retailers are entering difficult and challenging times, making everything even darker. We are still in the early stages of the economic nightmare, and for those who are unprepared, it still offers an opportunity to prepare themselves and their loved ones. Prepare yourself for the impending economic disaster before it's too late. While those in charge of the country are working to convince people that everything will improve, the numbers clearly reveal the true state of affairs. I will continue to discuss these issues. See you in the next video. God bless you all.